Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news, it only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Jeff, guess what?
We're live.
We are absolutely live. I have checked the last box and we are live. So we had some good, nice, awkward silence there for a couple of minutes. Me and Jeff looked like you were just kind of peeking at somebody while they're sitting there at their computer working away. But no, it is time for our live stream, Jeff.
It is. We have I don't want to jinx it, but here we are again on the actual first Friday of the month. It's crazy. We're kind of off brand.
Yeah, we're back on brand. We were off brand and then it became the brand. And then we got back on brand.
The thing I like about it is we make the joke about it being the first Friday, except when it's not. And I don't think anyone really gets the joke except me and you.
Oh, that's fine. That's totally fine.
Which is honestly, speaking of being on brand, this is
kind of better. Yeah.
This is an excuse for us to make inside jokes.
So I will make a comment. This is an inside joke for one of our viewers. I don't remember what FedEx was bringing, but UPS is bringing something now.
Yeah.
So
my favorite part of your background is I can see when you get deliveries. I can see when your son gets home from school, when your wife leaves the house. It's fun.
You can see all of it. You can see every bit of it. Cool. Okay. Hey, so welcome to our live stream. For those of you who have not seen First Fridays before or Investing Unscripted before, welcome. It is very good to have you. I must start things off with the most important part of our live streams. It's the most wonderful time for a beer. And I am having a beer. I am going to be drinking a beer to start our live stream this time. So cheers, friends.
Cheers.
Curious what everybody else is having out there. I see Eric DeVore is joining us. Good to see you here with us, Eric. Nice chatting with you earlier today.
Yeah, I am. I just finished my tea. I like to have tea when we record, get a little caffeine boost. If I have a beer while we record, I'll fall asleep, especially when you start talking about bonds. So I'm doing tea and water today. But yeah, as people come on, I'm sure they will, even if we don't ask them, Jason, they're going to share with us what they have to drink with them. But yeah, I'm glad we're here doing the live show. It is the last one of 2024. We have some portfolio stuff to talk about. We got some interesting topics to discuss. And as always, we are hoping for some viewer listener questions. We're happy to derail what we're talking about to answer the questions that people have who are watching. We got Teo joining us saying hello in all caps. So we'll take the questions as they come in. But Jason, I think a good place to start out is to talk about the portfolio contest, because it is now early December. So we have our November results and we can talk about who was the winner for the month. And we are almost done with this portfolio contest. And we are going to be thinking through over the next couple weeks here, what we want to do with the 2025 contest. So I'm just going to put it out there one more time. And we've actually gotten a couple ideas. We've had a couple listeners email us to give suggestions for what the 2025 contest might look like. But if anyone has a suggestion, we're open to doing it drastically differently, doing it similarly, and just tweaking around the edges. But I think we're in agreement, Jason. We want to do something different in 2025.
Yeah, it's also possible everything Jeff said was just to create false engagement, and we already know exactly what we're going to do.
I would never do that. I would never do that to our listeners. All right, so here's the results, not for everybody, but for some headline numbers here. So in the month of November, we're talking just about returns for the month only, not year to date. The S&P 500 was up 6% in the month of November. And
Go Trump, go.
yes, a lot of those gains came after the election.
Yeah, no, it's been the election rally, that's for sure.
Yeah. And interestingly, we had a lot of like double-digit returns for people this month, and it was actually kind of close. But the winner for the month of November is actually Teo, who is on the live stream right now.
Teo.
His portfolio on the back of Lemonade, which was up 118% in the month of November, is up 20%.
When life gives you Trump, buy Lemonade. Is that what you're?
I think yes. I believe that is the saying.
Yeah.
We had some close seconds. Up 16% was Brian Feraldi's portfolio. So he came close. I thought he might be the winner for a while. Up 14% was my portfolio. So for a hot second, I thought I might win November. And then Travis, who won October's month, was actually up 19% in November. So he came pretty close. We had a couple others that were up single digits, one that was up 10%. So that's the overall numbers for November. I think I was going to ask you what your high level takeaway is, Jason, but it's probably just that crazy things happen when elections take place, right? Like this was definitely, the story of November was definitely the bump we saw after the election.
Yeah, and I think it's especially true in the case where we have like a change of party and there's certain expectations around changes that are going to come. And so that's definitely the momentum is driving the market right now. And we saw that very, very much this past month.
Yeah. And what's interesting is, all the news stories right after the election when the market was popping is, of course, they're reacting to the thing that just happened, right? Market rally after election, blah, blah, blah. And I think people who don't follow this or know the historical data probably say to themselves like, oh, that means that Republicans or Trump or whoever, they're good for the stock market. But I think it's worth remembering that historically, when you look at entire presidencies, they all go up and to the right.
Yeah.
You see the dips where there's like the Great Recession or the pandemic or, whatever, pick your crash. But I think statistically, there's not much difference over pretty much the history of the stock market between one party's administration and another's. So a nice
it's exactly. It's just a good reminder that over the long, especially the short term, but it's really the same way over the long term, is that parties and the resident of the Oval Office always get too much credit and too much blame, right? It's always both of those. They get too much credit and too much blame. So it's going to take a long time to see the actual economic impact of whatever policy change may or may not happen over the next 4 years. So that's definitely important to remember.
And that's what's funny about it, right? Like all of the reaction you saw right after the election were the things that you would expect, right? Like the companies that, based on rhetoric during the election and policy statements and policy positions, things moved in the direction that you would think just based on what we think will happen. But it makes me think, so if stock Y was up 80% because of some perceived future event because of this particular election, then I start thinking, well, how much of that stock price is just baked in expectations that are just hope, or like, and not based in reality. So I hope no one was making trading decisions based on the outcome of the election, or if they did, they got a quick buck and then moved on. But I don't think it's anything to make any long-term decisions on personally.
So we have evidence that at least 2 people do read the emails we send out from our newsletter. John Dargan, hey John, good to see you, buddy. He says, thanks for the notification. Totally forgot about today's show. Glad to be here. We were glad you were here too. And Rita says, I like your hair, Jason. So 2 people that actually do read those emails. Jeff has no idea what Rita's talking about because he doesn't.
Did you put a joke about your hair in the?
He doesn't read our emails.
No, I see them and delete them immediately.
Yeah. I mean, that's what I would do. That's what I do when you are the responsible party. So it's the right thing to do.
That's fine. I support it and I'm okay with it. We were using Lemonade as an example here, and Eric points out that there was definitely a short squeeze involved in that pop. And I think that's probably the case for more than just that stock.
I'm actually I'm looking it up for Lemonade because the numbers are pretty bonkers in terms of like the short float. But I want to give them because it's still pretty big. So give me a second to put it in here.
Yeah.
Let's see here. Okay. All right. So yeah, percent of shares outstanding short. It's still 22%. It's still 22% as of, last week, I think was the last data we got. It hasn't come down a lot. It was just under 24%, back in late September. So it's still really, really high. As much as the stock has come up, it's still really, really, really high. So
let me ask you this. I kind of get why people would still short Lemonade. Does it make sense to you? I mean, neither of us are people who short stocks, but just understanding why people do and what it's about. It's not always that someone thinks a stock's going to go to zero, or not even that a stock is a bad company or tied to a bad company. Sometimes it's just the valuation got ahead of itself. It's got tough times ahead. I just don't think this is sustainable. And like just watching the volatility in Lemonade stock over the couple years I've owned it, I kind of get it. I mean, you're rolling the dice because it could also pop and go up a lot, which is what happened after the election. But the idea that it might go down significantly is not crazy. What do you think?
Yeah, I think it's really important to remember too that a lot of the industry professionals out there that short stocks, a lot of times they're doing it over temporary valuation things. They think a stock has gotten ahead of itself, and they're betting the price is going down. A lot of times just for temporary reasons. They're not necessarily saying this is a bad business or I'm writing it to zero. So that's important, right? I think a lot of times because in the investing public, we think of short sellers as these nefarious bad actors, because that's like the biggest thread is what we hear and see are the short reports that come out from these short operations. And as we've learned over time, a lot of them have big backers that are paying them, right? They're taking these short positions, and then they're publishing something to punish the stock. So we think of them as doing bad things on purpose that are hurting otherwise good people. So that perception isn't like, it's not the reality of how most of shorting happens. Shorting is a healthy part of an investing market, right? So I think that's important to remember. And yeah, for a company like Lemonade, yeah, I could, because like I get laughed at and kind of drugged through, like people will comment in these groups on Twitter that you aren't in, but they're public groups. And if they tag you, you can read all the comments, even though you can't like respond. And a lot of times people think they're doing this and it's private and like, they don't know that you're seeing it. And people say some pretty mean things about me not knowing how to value Lemonade and like that kind of stuff. And like, here's the reminders that sure, using like traditional valuation metrics for a company like Lemonade today aren't the whole story. But at the end of the day, book value per share for an insurance company is really important, and understanding where it's valued now and being able to project that over time absolutely matters when making an informed decision. And when any stock becomes so detached from that metric based on what the business is able to do, then it makes sense a lot of times for shorts to come in and make money. Or if the other way to think about it is maybe you're not going to short it, but maybe the stock has gone ballistic and you've earned multiple years of returns in a very short period of time. And maybe it is time to sell some of that out of your own portfolio. We were actually texting with our friend Lou Whiteman, who kind of made fun of me a little bit for some comments I made on our previous podcast, where we were kind of talking about thinking versus acting. Sometimes when stocks go kind of ballistic. And I think there's some truth to that, but you have to be thoughtful about it. Because in a way, taking gains at the top is not necessarily different from shorting a stock, because you're doing it for the same reason. You're doing it because you think there's a good chance the stock might go down.
Right.
You're just not betting the stock is going to go down. You're selling it to avoid it going down, but you're acting based on that same exact thing. And for Lemonade, this is the last thing I'll say about it. The stock has gone crazy because they got some analyst upgrades. They had good earnings, the Trump election, and like the final like rocket fuel on it was that the investor day they did, where they said they were going to basically 10x from about $1 billion in policies to 10 billion in policies at a 30% CAGR. So what is that, like 6 or 7 years? They're going to 10x. That is crazy aggressive, right? That is very, very aggressive. Considering they've grown well, but they haven't grown profitably until now. Like they're just now cash flow positive.
Right.
They're saying they're going to keep losing money for a couple years. That's going to hurt their book value per share. There's legitimate reasons for investors to be betting against the stock.
Yep. The other thing I just want to say about short sellers generally before we move on is like, I don't know that I never had the misconception, even when I was brand new and learning, that short sellers were evil or nefarious. I guess I could see that side of it when someone publishes a short report, like that's the reason. But I always assumed it meant, oh, you think this company is a fraud or is like fundamentally flawed and is gonna go to zero. And but what I've learned is what you just said. No, sometimes it's just ain't no way this is worth this much. So I'm gonna put some money down that says it's not worth this much.
Right.
And I'm sure there's very knowledgeable people who've made a lot of money shorting very good companies who just got, whose stocks got ahead of themselves.
Yeah, no, that's exactly right. Love it. Eric DeVore is getting into the banter here, following up on Rita's compliment of my hair, that she likes my hair. Thank you, Rita. Eric says, well, Rita, that makes one of us. So thank you.
So, all right, I want to take John's comment here. John Gallegos has joined us. He says, hello, gents, and all unscripted fans. So happy that my DocuSign cost basis is back to even. Yeah, DocuSign was up double digits today. 20-30% last time I looked. Maybe it cooled off later in the day. So I want to talk about DocuSign just really quickly because I think it's an interesting stock because even after the crazy day today, and it's had a good year, I think, if I'm remembering correctly, I looked at it kind of recently, it's still down so far from its high, like from its 2021 high point. So good for you, John, getting back to even. I sold my shares a long time ago, but I went back and looked. I would still be significantly underwater today if I had held them, even with the better run it's been on over the last year or so.
Well, just some context on how the 2020, 2021 peak, how many companies across so many industries that it affected. It's not just these tech stocks. That wasn't just startups, money-losing SaaS companies. Brookfield Renewable stock is still down. From its peak 3 years ago. Like over the past 3 years, Brookfield Renewable has lost investors' money. There are a lot of stocks that got caught. I remember at one point, the yield was less than 3%. And this is a stock that typically yields 6% plus. So a lot of things got very detached from their valuations. And I think it's a reminder that like we're in this momentum phase now where there's a lot of stocks where momentum has kind of taken the wheel. It can last for a while. It can definitely last for a while. And that's why you really have to start focusing on, what are your financial goals and get back to like your principles as an investor and your framework based on your goals and make decisions based on that and not whatever else is going on outside. You don't swing at the pitch based on how loud the crowd is cheering. You act based on the things that are happening involving your actions.
And it is funny how if you bought a stock that was caught up in that crazy bull run in 2020 and 2021, especially if you were a newer investor like I was, it taints the way you look at that company forever. So for example, I owned DocuSign. I bought it probably in 2021, sold it in 2022. It was one of those ones I bought early on just because I had heard of it. I knew what it did. I don't think I had a ton of conviction or understanding of the company. And then of course I bought it like the absolute worst time and then it was down a lot and I ended up selling it. Right. And I follow it pretty closely still. And it's been doing like I write little write-ups on each quarter's results and it's done well for several quarters now. It's profitable. It's cash flow positive. It's growing revenue and users around 10% a quarter or, year over year, every quarter. And I say to myself, maybe I should look at this again and just consider it. And I just can't. It's like it's forever in my brain as this stock that got caught in a bubble. But if you bought it, at the low, it's probably has done pretty well for you. So it's one of those stocks where it really does matter where you bought it over the past 5 years, in terms of how you feel about it now. But that's just like an investor bias I have to get over, I guess.
Yeah, but it's easy to do. I mean, it's not even investor bias, it's a human bias, right? We anchor on things that happen in our lives that affected us in some way. So that's totally normal.
Yeah. Okay.
Cena in the house, Cena Hasuna. Hey buddy, good to see you. Glad you're here watching this live stream instead of enjoying that holiday party you're out with your family. Priorities. Nice job.
Hey everybody, we'll be right back, but first a word from our sponsors.
FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. So I want to ask you how you're feeling about AI. We talked about this a little bit on the episode we recorded yesterday that will be out on Wednesday. So if you're listening to this after the fact, but before Wednesday, this will happen in the future. And it was related to us talking about how we think the Mag 7 is going to do over the course of this coming year. And my hot take, I guess, was that if the air comes out of the AI bubble, I thought Apple might do better than the rest of the Mag 7 simply by just not having so many eggs in the AI basket. I know they're doing their own thing, but I don't think they're nearly tied to the mania as NVIDIA and Microsoft and Amazon. And so there was this Deal Book Summit earlier in the week that the New York Times holds, and Sundar Pichai said during that he believes that AI development will slow down in 2025, but he's confident that it's not plateaued. And I thought that was interesting. That was the first time I've come across someone who's, leadership in one of these big tech companies that has acknowledged that we may be slowing down a little bit here.
That's Alphabet's CEO.
Yeah.
Yeah.
And
no, I know that. I'm saying that for our viewers.
I appreciate that. And it just struck me as odd. Like, I feel like you say something like that when it's true, but then you try to couch it with but it hasn't plateaued.
Yeah.
So I'm curious where your head is. This is completely vibe based, so I'm probably wrong. I feel like,
well, you are the voice of the people and the bringer of the vibes, Jeff. So
yeah, maybe we got a little ahead of ourselves here. Maybe some of this insane spending was a little much, but I don't know. Maybe we're just laying the groundwork for a decade from now, and it'll be there. So, what do you think? What is your vibe check on AI right now?
So I don't know. I think, that's a wholly unsatisfying answer, but, and I don't think we're going to know for a while, but.
All right, let's move on. Next topic.
No, I mean, look at DocuSign. This is an example of a company. They made an acquisition, that they closed last quarter, and they've integrated the AI from that company that they bought into their their core product and their integration that they have that ties into other enterprise software. And it was really only a couple months of the quarter that it paid off, but they really said this is really driving like serious attachment and business for us. They talked about growth rates, net new customer acquisitions that were driven by this. So things like being able to users that are on Microsoft like Office or 365, but they have Copilot. So that's Microsoft's AI integration. Being able to use Copilot to search through the DocuSign tools that they use for document management through Microsoft. So we're just now, I guess my point is we're at the point where we're seeing more and more companies talk about not just mentioning AI and how they're innovating with AI to wave their hands and say, we have AI too. They're saying, here's how AI is driving business for us. We heard some of the same stuff when Salesforce reported that they're getting a lot of traction with artificial intelligence. And I'm of the opinion that we're probably at the point now where we're going to be seeing more. And I think I said this on the podcast episode that you were referencing to, that my expectation is that we're probably going to see a lot more of the enterprise cloud software companies that are already established, like in their lane, that are probably going to have a lot of success with AI because they're trusted and their customers, they know their customers, they know their customers' industries, and their customers trust them to bring tools that like actually work for them and aren't going to like break compliance or use their information in ways that they're not supposed to. So like, I feel like we're kind of at the forefront now of like the acceleration of monetization of AI broadly. Like, I think it's starting to happen. And if that really does continue to ramp up, then, I don't necessarily know that there's going to be a lot of overspending. I think Pichai's right that, spending is going to slow. But probably just because this has been the ramp up of getting the infrastructure in place just to support it.
Yeah. And that's where I feel like I'm probably wrong, is the spend that has gone to the infrastructure is probably well spent. I think my vibe check on AI is more around, I don't feel like the vibe is that this is going to be this huge transformative thing in the next 2 years. Like, you know, when ChatGPT first came out, it felt like everyone was in consensus that within a year we will speak into the air and all of our laundry will be done. You know, it was like these like crazy dreams. And now it feels like exactly what you were just talking about. Like, we're going to be in some software that we use or on some website, and there's going to be that little button you push, and there's some large language model working in the background that can help you be 6% more efficient while you're on that website. Like, I just feel like it's going to be thousands of those types of products, and that anything actually transformative is going to come from a company that hasn't even been founded yet. Like, that's kind of where my head is on it. So it's interesting. I don't know. We'll see how it goes. It does feel like some of the air's out of the balloon. That's probably a good thing, but I'm curious to see how it impacts the returns of these big mega companies that have been spending billions of dollars.
Yeah. And I think if anything, a lot of it is going to be just maybe propping up existing valuations more than necessarily, you know, the air coming out of the sales, so to speak, of a lot of stocks. Because the expectation is that AI is going to pay off for a lot of these companies already. It's already baked in. I mean, look at DocuSign, you mentioned that's, you know, you're kind of back. A lot of that stock price coming up was because like, now we're expecting it. Now we see something, you're telling us something. Now we're expecting it. Microsoft's had a hell of a year, the same thing. So it's kind of there. Of course, our friend Tyler Crow is now in the audience and says, and that concludes another episode of Confessions of a Shitco Buyer. So good job, Tyler. Welcome back, buddy.
Yeah. Tyler likes to throw shade on the podcast, on the live stream here. Tyler, since you're watching and listening, and you're probably waiting for me to say it, Outset Medical. So now you can drink.
And
well, all right. Let me push back on Tyler a little bit here, just because it's fun and he can't respond. at least not with his words.
Well, he can respond, but we can ignore him.
Yeah, not with his voice, is what I meant to say. Do you think DocuSign is a shitco?
No, no. I think there are a lot of DocuSign is included in this. There are a lot of companies that went public with extremely exorbitant stock-based compensation plans that investors still don't always, when they look at their cash flows and their return metrics, don't adjust for how much new stock is getting given to insiders that is chewing away at per share value. And I think DocuSign is still one of those companies. It's gotten better. I mean, they've cut so much of their staff. They've cut like 20% of their workforce. So that's a lot less stock-based compensation getting issued right there. But the point is that that's still like a big thing. And you're not, I mean, Microsoft, if you want to talk about companies with massive amounts of stock-based compensation, Microsoft pays out billions and billions of dollars in stock-based compensation, but they also generate, tens of billions of dollars in profit and buy back more than enough shares to offset that. Right.
Mm-hmm.
So that's the key. We're not seeing that side of the story for a lot of these companies, and we won't for a lot of them. They'll never really do it. I've talked about it with Block, Square. It's essentially all of the additional per share cash flow that's been created over the past 4 or 5 years for the company has been given to insiders and dilution. So I think excessive dilution without buybacks to cancel it out can classify companies as shitco.
Yeah. Yeah. I mean, I agree with the stock-based compensation. I think I totally get where Tyler's coming from. I mean, not to defend my own decision, but I bought that out of ignorance. But
you bought out of ignorance, you held out of stupidity. I'm kidding.
Yeah. No, I mean, I'm not going to lie about that. I just think there are some egregious examples of stock-based compensation. I know DocuSign is one of them. But if you are a believer in the company and the platform, and by the way, I'm not, I just feel like there's too many competitors out there for me to feel like now in my 2024 hindsight glasses on, like, I don't know that, like, I've signed a lot of documents digitally and not used DocuSign enough that it makes me feel like I don't understand why they would be the ultimate winner here. But again, when I chart out their quarterly results, nothing is terrible right now. I don't know that it's enough growth to justify like growth stock valuations or anything like that, which I get is part of the calculus of buying a stock and hoping for a return from it. But I feel like if they can become a return to growth and become the winner in the space, doesn't the stock-based compensation thing at some point work itself out? Now you have to be careful as an investor until it does.
Yeah.
But I guess that's why I would stop short of calling it a shitco.
Right. Because it is a real company that actually generates cash flow and has good margins and has expanded them and is expanding its business.
Like this isn't like a pre-profitable, cash burning, we hope it hits profitability company. Like they're there. So anyway.
But to Tyler's point, I'm going to share his, I'm not going to ignore this one because I think, but it's to the point. Over the past 5 years, $2.5 billion in stock-based compensation for DocuSign. So it is, again,
I call that a good start.
Well played, sir. So I want to, Ryan, where's it at here from Ryan Schroeder? This is a good one because this is talking about the AI thing. He mentions Agentforce as someone who's actively helping companies implement Agentforce currently. I think it's going to take off pretty quickly. Agentforce, that's Salesforce's AI thing. And the bottom line is that companies can find ways to drive better performance for their sales staff, drive out cost and replicative, redundant tasks, repetitive tasks, that kind of stuff.
Yep.
I mean, it could be amazingly powerful. So think about just like here's a goofy example of a thing that I think AI should be able to eventually do. You get an email from a client, a manager, somebody saying, hey, this thing that we talked about 2 years ago with this document, we need to revisit that. Can you pull the files and set up some time? There's no reason that an AI agent shouldn't be able to jump into your DocuSign or Adobe Cloud, whatever you're using, find the relevant documents, look at both of your calendars and create the meeting and create a summary for both parties. There's no reason that AI shouldn't be able to do those things. And all of a sudden you've just saved somebody 20 minutes of time.
I agree. But that's exactly my point. Like I think it's going to be important, and I think it's going to help businesses. It just feels like I'm starting to feel like we're all realizing it's going to be a bunch of little things rather than this huge consumer facing new product like ChatGPT was when it came out. Right. And I feel like that's where so much of the hype was. Oh, it's going to revolutionize search, and, but that was like a big consumer facing thing. And the other products too, Gemini and all the other ones. But I agree with you. I mean, look, this is another stupid example, but I've noticed Gmail has had those like auto reply suggestions for a long time now, right? So someone says like, hey, thanks for sending that. I'll see you at the meeting tomorrow. Like, it'll suggest for you to say, no problem, see you soon, right?
Right.
Even that has gotten better, I've noticed, because I use those a lot in my day job. Because there are times when a mass email goes out on my behalf and I get hundreds of responses from people, and I can't and don't need to respond to most of them. But when I do, I love to just be able to click and be like, nope, you're all set, thank you, and not have to type it. But the versions I get from people are slightly different, right? Like, so Jason writes back and says, hey, thanks, I appreciate it. And I get one version of auto reply, and then someone else writes back and says, I have a question, and it answers it differently. So, and that's huge for me. Like, that saves me a lot of time. But to me, those are helpful, and I think they'll save some companies money. But that doesn't line up in my brain with like $100 billion of AI spending, But I guess if that spending is to build up the infrastructure to make all that stuff work, then it does make sense. I don't know. It just feels like we're in a different place with it. I guess that was my point. But yeah, I'm glad Ryan shared that, because that's good insight. Hey, everybody, we'll be right back. But first, a word from our sponsors. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast, because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
All right, next topic.
Yeah, let's here's where I want to go next. I want to talk about Bitcoin, because the big news this week with Bitcoin was it briefly crested the $100,000 mark, which was, there were a lot of online bets out there and predictions. What would it hit first, 100,000 or 50,000? Would it go back down or whatever? And it tipped over 100,000 at some point over the last couple days.
It's over 101 today.
Is it? It's back over? Okay, I know.
Yeah, it's over 101.
Yesterday it was a little under 100. So look, I own a little bit of Bitcoin. I bought it again at the absolute worst time. So like, I have a good return on it, but it's not, nothing incredible. I'm not planning to retire based on my Bitcoins I bought in 2008. I guess I want to ask you, Jason, like, where is your head on Bitcoin specifically, crypto generally? And I still can't figure out, like, I'm happy I own Bitcoin, but the reason I'm happy is because it went up.
Right.
I don't understand what else it does. And I know I sound like an idiot saying that, but I guess it's turning into a store of value. I just can't, I don't know. So
we'll
see what the listeners have to say as well.
Yeah, I'm sure we're going to get some comments there. So I'll say this, like, so it's, what's going on with crypto right now is wild. Like, it's wild. I bought my first crypto in 2022, started with Bitcoin and Ethereum. added some Solana. It's or 2021, and then I bought Solana in 2022. My crypto portfolio, it's small, has more than 5x'd since basically 2.5 years, right? It's, and what's happening now, obviously again, it goes back to the Trump administration, incredibly pro crypto people that are going to be a part of the administration. So yeah, that's driving it right now. That's the narrative. Circling back around to use cases, it's the same story, right? We're not talking about it because they're all going up, but like they get talked about more when they're going down because people are like, well, why? Why would anybody even have done this? But the use cases are the same. It's like programmable money is a big one. The velocity of money is important. So if you're sending money to somebody through most traditional channels, it can be days to weeks before you can actually get that money, right? And actually separate it from the financial institution. It gets tied up. It takes days to transfer and before they'll release it to you and all that kind of thing. And then the fee structure. So you think about like so many businesses, convenience stores, for example, their net margins are, low single digit percentages, roughly equal to the fees they pay to, card processors, right? Mm-hmm. So if you can eliminate card processors, the company is twice as profitable, just like immediately. So things like crypto. What's that?
No, I want to. Okay, I get all that, right? Like,
right. So those are all still there, and then you have more complex use cases where things like Bitcoin can be really interesting because Bitcoin is still super secure, like super duper secure. And the idea is that when you have complex transactions where trust is important, you can use like smart contracts. That's still kind of like one of the key things. That's one of the use cases for Bitcoin.
Is it? Okay. So but I guess that's my point, right? So if you're telling me that here's why I own crypto. I'm going to be 100% honest. I own in total, I have probably spent a little over $1,000 in total on crypto. And I did it entirely as a learning thing. I was like, you know what? Let me just buy a bunch of different things. I don't trade it. I just kind of did it and I let it sit there. And there was a point when it was down, in the crypto winter, it was that little portfolio was down to like $300 or something like that. And I was like, I told myself, well, as soon as it gets back to zero, I'm going to sell it and get out of this. And then I didn't, of course. I'm just going to never touch it. I'm just going to leave it and just kind of like learn and see what happens. I guess what I'm struggling with as a person who tries to learn as much as I can about the things I own so that I can make informed decisions about whether I should buy or sell them is I don't know what the informed decision is for buying or selling any of these other than reading up on the specific, thing that this little crypto coin does or the smart contract that it is trying to be the blockchain technology behind it. And with Bitcoin, I've not yet seen it. I don't see the use case for the things you're talking about. Like, point to me where you can actually sign a smart contract and Bitcoin is involved, or point to me where you can send money overseas or buy something with it.
I didn't say anybody was doing it.
No, I know, but that's my point.
I just said those are still the goals.
Like, it can't
and I know that there are tools out there.
It can't be a currency till it's less volatile, right? Like, you hear those
Yeah,
stories about the people who bought a pizza with Bitcoin in 2009, and it's like that was the $90,000 pizza, right?
Yeah.
Like,
no, I think them being called currencies is probably the biggest disservice because a currency is a thing with that everybody trusts and has a predictable value, right? And you don't have that with very many crypto assets except for the ones that are pegged to the dollar, right? So that's the kind of crazy irony. But again, getting back to Bitcoin, the big key with Bitcoin is that finite supply. 21 million is the most that'll ever exist. And there's going to be less than that, we know, because there's already been plenty of stories about people that had them on thumb drives that got thrown in the dump, right? So that finite supply is important to the value creation too, because it is a store of value too. So, think about it. Gold is a store of value because people think gold's valuable far more than its actual practical uses. There's industrial uses for gold. there's consumer uses for jewelry and, that sort of thing, and in consumer electronics. But at the end of the day, most of the gold is valuable because people think of it as a valuable asset and a store of value. And if we're just going to think about gold's going to get treated as a store of value, there's no reason why the same thing can't happen for a digital asset too. It's exactly the same thing, because most people that invest in gold, they don't have gold in their house. They have it in an account somewhere. Now there's real gold.
But you can extrapolate that to anything. I mean, money.
Of course you can.
Well,
it's happened historically
because we all agree it works, right? Like,
no, that's it. I mean, that's exactly right. But I mean, our entire system of commerce works because we believe in the value of the things that we trade for goods. I mean, that's so I think it's easy to overcomplicate it, and question it because it's a little bit different. You gotta remember, we have an entire generation that's a lot of their life is virtual and digital, and it's easier for a lot more people. And going forward, even more and more people will view things that are virtual with more value than people in the past have only considered things that were physically tangible of having any worth, right? So that's a big transition that's happening in society broadly. And like, if you're going to have something that's just going to be a store of value because everybody believes that it's valuable, I mean, Bitcoin's a perfect proxy for that because it's also portable. You don't have to, it's easy to turn into money, compared to gold, right? Whether it's digital gold or real gold, it's difficult, and getting value is harder. So like, just from a like that point of view, sure. Why not? Now, why has it gone up so much? Because the fact that it's this decentralized thing that's becoming increasingly concentrated into more centralized exchanges. Look at the ETFs that hold it now. They hold a massive amount of it. People trading it on Coinbase, or the ETFs, instead of actually possessing it, on a tangible device on their computer or on a secure drive. So
yeah,
it's like the opposite of the whole point, is what's happening. It's becoming more concentrated.
Yeah, and I'm sure at some point in history, two idiots were debating the same thing as it pertained to gold, or as it pertained to silver coins, or as it pertained to paper dollars. Like, I'm not naive to that point of it. I think it's just interesting to me that I guess the biggest case for all of these things is like, you're buying on the hope that it becomes a thing in the future. Like, you're buying on the hope of the use case. I don't know, we have a lot of comments in the thread here. I don't know where you want to go on this or how much time you want to spend.
Yeah, I do like Eric's comment that, I think it was Eric that said it, Eric DeVore, pointing out that Bitcoin and crypto are two different things. It's kind of, I mean, broadly, I think a better way to think about it is there's crypto, and then there's the altcoins, right? Also called shitcoins. So right. That's because you have others that are more like Bitcoin, but Bitcoin, the big thing is like the limited supply, because just about all the other ones, there is going to be an increasing amount of supply over time. To even ones like Dogecoin, I think it's like 10,000 new coins a day. Like, it's a lot.
I think, and I don't know, of course, when it goes up, I think to myself, wish I had more of it. That's the natural human thing to think, right?
Yeah.
But like, when I feel that way about a stock I own, I at least have something to make an informed decision on in terms of like, when might I buy more?
Mm-hmm.
And I don't know how to answer that question with
a year ago.
I have to go back and look at the chart and when it went down.
Yeah. So Josh Johnson has this. I want to share this one for anybody that's not reading the comments on YouTube. Derek Thompson's Plain English podcast had a great episode this week about crypto and use cases for anyone interested. So we're recording this on December 6th. So this is Friday. So it was this week. Derek Thompson's Plain English podcast. Thanks for that, Josh. Anybody that's interested, that's worth checking out for sure.
All right. We could keep going down the crypto rabbit hole, but there's only about 15 minutes left, and there's something really important that we have to get to. So on the episode of our podcast that will be airing next Wednesday, the 11th, we did our predictions for 2025. And we also reviewed the predictions we made in 2024. And Jason took the time to go back and listen to last week's episode, which I think we're going to run as a separate
last year's episode.
I'm sorry, last year's reckless prediction episode where we predicted what would happen in 2024. And we're doing this a little early. It's only early December, so there's still time for things to change. But we have some other stuff planned later in the month, and this was when it fit into our schedule. So Jason went back and listened to last year's episode, and I don't want to give too much away because I think it'll be fun to listen to that on Wednesday. But we did say when we recorded, I'm so confused about like when we record things and when people are going to hear them.
It's very meta.
Yeah. When we recorded for the episode that will come out on Wednesday, one of the things Jason predicted was that I would outperform him.
So my 2024 reckless prediction. My 2024 reckless prediction. So the whole vibe of our reckless prediction shows is that the predictions are going to be wrong, right?
All of them.
So my prediction was that Jeff's portfolio would outperform my portfolio, real world portfolio, because I was playing 4D chess and trying to set my portfolio up to outperform Jeff's.
So by saying I would beat you thought you would like karma yourself.
Oh, absolutely. Yeah, because that's, making a prediction is far more important than the actual act of doing the thing. Right?
All right. So before we recorded today, we both went into our brokerage accounts and looked at our year-to-date return. So this is through the close or close to the close. We did it a little bit before 4 o'clock.
It was the close yesterday through the 5th.
Oh, through yesterday's close. That's
Yep.
right. Because that's how we're both with Fidelity. So we just went to the Fidelity website and looked. So year to date, I'll give a little context here. Year to date, or year to yesterday, the S&P 500 was up 29%. And I have all my stocks in a brokerage account and a IRA. So I went onto the website and figured out like just those two accounts because I have some other stuff in my Fidelity account that I didn't want to count. So with the market up 29%, year to date, my portfolio was up 30%. Oh no, 29. I was 29%, right, Jason? We talked about it earlier. I wrote it down.
No, 32. Told me 32.
Well, 32 by my calculation, but I went with.
Oh, and then when you went back,
Fidelity said.
That's right. Yeah. So yeah, 30.
So
30%.
I am. Yeah. So I'm beating the market by 1% year to date. Jason, tell the people about your returns.
My returns were very, very good, and they would in any year you would be very happy to get them. They were roughly double the market's long-term average, which is around 10%, which means that my prediction, Jeff, was right.
Yes, it was.
Your portfolio outperformed mine. Mine was up. My portfolio was up 20.8%.
That point is important
in 2024 for the first 11 months of the year. So congratulations so far. I want to talk a little bit about this though. I do want to spend a couple minutes and talk about it.
Wait, hold on. No, I'm not done gloating. No,
please keep loading.
No. I actually, what I was going to say is I don't want to gloat because there are still 14, 15 market days left in the year. And I do not want to jinx this or screw it up. So we should remember in early January to talk about maybe on the January 1st Friday. Let's see how the year actually ended up. We'll return.
That'd be fantastic. Let's definitely do that. But I want to talk through it a little bit because there's some things that I think are material and important. And I want to say this first. This is definitely not any sort of like trying to make excuses or any of that at all.
Isn't that the thing that people say right before they start making excuses?
It is, but this time it's different. So this is no, but seriously, this is the returns that they report. This is everything that's in your portfolios. So bonds, bond ETFs, cash, money markets, everything, right? So it's not just weighting the performance of my stocks.
Mm-hmm.
It's including.
Oh, because you have bonds in your portfolio.
I have bonds. I have far more cash than you do.
A lot more cash, yeah.
So, like, there's no caveats. The return number is the return number. But so my point is that most people, if you're just measuring your stock performance, my stock performance was definitely better than this. I think even if I backed out those other things where I'm getting between 4 and 6% in yield on the cash and the bond ETFs that I own, you still outperform me. So that's fantastic.
Just want to.
It'll never happen again.
One more.
No, I'm kidding. I hope it continues to happen. But the thing that I really wanted to focus on is that we've talked about this a lot over the past year, not just, a few months ago when I started making like the big decision to move large amounts of money into bonds. That's only been a few months ago. That didn't start at the beginning of the year. But I started shifting more and more of my portfolio to cash at the beginning of the year, right? So this is a perfect example of how cash can weigh on your returns, right?
Yeah. And to be clear, it's fun anytime I beat you in anything, but I am not actually in any way super proud of this, only because even if I was crushing the market, like let's just say I doubled, the market was up 30% and I was up 60%, right? This is still 13% of my invested wealth, right? And
you're lying. You're really proud of this.
I'm super proud of it. But the majority of what we have invested, my wife and I, is in index funds and actually bonds and things like that. Like, so I'm never going to beat the market with that part of my portfolio. That's just not what it's designed to do. Like, that's not what the benchmark is. But so actually I hope I get to a point where I'm beating the market by a more significant amount with this part of my portfolio because it is such a smaller percentage. But yeah, we're constantly over the course of the year finding stupid little things to compete against each other with. My favorite was a couple of years ago, we made a spreadsheet where you bet that Taiwan Semiconductor would outperform NVIDIA. And it was before all of the crazy AI stuff.
Right.
It was actually probably a smart bet to make in like, I don't know, late 2021 or whatever it was. And that has not turned out well for you either.
No, but it's the kind of thing where, it would have been a stupid binary bet, like to actually figure out a mechanism to like make that bet, and you lose if NVIDIA does better and you only win if Taiwan Semi does better. But being bullish on both has worked out really goddamn well because Taiwan Semiconductor now has become it's $1 trillion market cap company now, Jeff.
Yeah.
I don't know if it's going to stay that.
And I've never owned it.
It could happen with the cycle, but it's remarkable what has happened.
All right, we're going to pivot to some non-stock related stuff. Let's have a little fun here with the audience in the last couple minutes. So I don't know about your school district where you live, Jason, and your son goes to school, but around here, my kids, for example, and where I work, 2 full weeks off for the Christmas break just because of where the holiday falls in the week.
Woof.
So, and
no. So,
but I'm curious, when you have any sort of long break, right? Whether it's just that you go on a vacation or your kid's home, what do you like? What's a fun like holiday break activity for you guys? Like, what's something you like to do?
Go play golf with some friends and leave my son with my wife.
Yeah, I like to go to work.
Yeah.
I got to go in this week, hon. I'm sorry.
No, my son has become a sports nut. So there's a good chance if he's out of school, we're going to end up on a soccer field somewhere, kicking a soccer ball. That's like a pretty regular thing in my life now.
Yeah.
It's just pretty painful because I spent most of my life making fun of people that played soccer. So that's,
you have to be careful with that before you have kids. Yeah, my kids are indoor cats, so that's not so much something that I have to do. My favorite thing to do...
You're cleaning up teenage hairballs?
Yeah, basically. My favorite thing to do, I think, is just, that's when I catch up on like the things around my house I should have been doing the whole year. Right? So like, I'll clean my office. Like that'll be this is the week I do it. All right, other holiday fun for you and our listeners. All right, what is the best Christmas song? And we're using Christmas because this is the holiday you and I celebrate.
Yeah.
So
I'm pretty old school with Christmas songs. I will be generous with this one and say anything that is not Mariah Carey.
Yeah. All right. You're going to love my next question, but I'm going to give my answer. And by the way, we have many listeners here. Please give us your answers to these too, especially Eric.
LDP says none. Love it.
Eric, you're a composer. You have to have opinions here. My favorite is any version of the Christmas song, Chestnuts Roasting on Open Fire. That's just my favorite like tune.
That's I can get behind that. I can get
But
behind
like,
that.
I say any version. I shouldn't say that because then Mariah Carey will make one and I'll not want to hear it. Like any of the classic, 60s crooners, right? Like a Dean Martin or a Frank Sinatra, like that kind of vibe.
Yeah.
I like that.
I agree. And it's funny because that's what I grew up hearing, and now that's what my son grows up hearing. And we've got, you'll be proud of me. I've moved from Pandora to Spotify.
Got the Spotify moving out of the early 2000s. I'm proud of you.
I know, right? It's pretty crazy, but we've got it linked with our Alexa. We've got multiple Alexas, and we can do like the group music and all that kind of thing. And I asked my son before we turn on Christmas music, what he wants to listen to, and he always wants to listen to the old stuff. So that's kind of fun. It's kind of fun.
Yeah. Eric's saying Nat King Cole, ultimate version of that song. Agreed. That's a great one.
Pretty great.
Tejo says Fairy Tale of New York by the Pogues. I don't know that one, but I'll go with it.
Yeah, it's not exactly the happiest Christmas song you could ever listen to.
All right, we're going to flip the script here. What is the worst Christmas song?
Anything by Mariah Carey.
I had a feeling that's where you were going. See, I agree with you, but I didn't want to go there because it's too obvious. It's too like on the everyone. I'm going to do the one. I will say
Santa Baby's starting to work its way into my.
Oh yeah, that's a terrible one. Yeah. I'm going in two different directions with mine. I've always hated the Bruce Springsteen version of Santa Claus is Coming to Town, and I know that that's heresy when you're from New Jersey.
Yeah,
but I hate it. I've always hated it. It drives me nuts. And I'm also going to put up there, and this is controversial. My son was arguing with me about this one. Wonderful Christmas Time by Paul McCartney. And I want to be clear. I love Paul McCartney.
It's pretty bad.
He's a treasure, but I absolutely hate that song. It drives me crazy. You know how certain songs remind you of like decades and eras, and any song that reminds you of like the early 80s should probably just be banned. That song,
so you're not. So you're just not a Wings fan, I think is what I'm hearing here.
It just screams like that time.
Yeah,
and I just hate it. All right. Do you have any other specific dislikes other than generic anything by Mariah Carey?
Yeah. So there's the lyrics are really dodgy from "It's the Most Wonderful Time of the Year." They're sitting around the fire. How many ghost stories have you ever told at Christmas time? And what are the tales of the glories of Christmases long? I'm pretty sure there's like if you're like following the whole Christian tradition, there's like kind of only like the one glory of like that first one. There's not like a series of Christmas glories here, right? It's dodgy as hell. The lyrics are dodgy.
All right.
No.
If we're going to go dodgy lyrics, you could have a long debate about Baby It's Cold Outside, right?
No. That's just a thirsty dude. That's not a date rapey song. It's not. No, I'm going to push back.
LDP here says that Feliz Navidad song or A Holly Jolly Christmas by Burl Ives. I would agree, though. Those are just overplayed, and I think
I love them.
You hear them all the time.
That's fine. I'm okay hearing those all the time.
A little too overplayed for me.
That's fine. I won't disagree with you there. I love them, but I won't disagree with you. Yeah. Yeah.
Anyone who's live should go through the thread here. Eric's just given banger after banger of specific arrangements of Christmas songs you guys should all check out. He would know. No. He is a composer. He would know.
He is the expert, subject matter expert. That's for sure. Yes.
All right, Jason, we are coming up on an hour here, so why don't we wrap this thing up?
Yeah, this has been a lot of fun. Thanks, everybody. Appreciate you joining us for what is going to be our last live stream of 2024. And it's exciting that we were able to actually get it on the first Friday. Stay tuned. A lot of great content this year. I just want to say this since it's live. It has been a fun year of continuing to do this podcast, making this live stream part of our regular routine, and seeing more and more of you come to the live stream. If you haven't done the live stream before and you can, it's 4 p.m., first Friday of the month. Join us for it when you can. Those of you that are going to listen to this just through our podcast feed, thank you so much for being a part of this. We got some great content. We have at least one more guest coming up for the year that I think you're going to love. And we want to hear more from you about content and guests throughout the year. Keep the questions coming, keep the engagement coming, and give us some recommendations too. Go to your app, please give us some recommendations. Don't forget, this is just what we think about the world. You got to figure out your own answers when it comes to investing. You can do it. I believe in you. Jeff, well, that's between you and Jeff. All right, buddy. We'll see you next time.
See you next time. Thanks, everybody.